This week's wild swings in the market do have the Chartmaster warning us about some more pain to come from stocks, as we've been discussing as a possibility. So let's get over to Cornerstone Macro's Carter Worth. Carter, what do you got for us?
Yeah, I corroborate with the desk. I mean, obviously there's a cautious tone, but before we look at the charts, I think it's important to say we all think in principle that up days are good and down days are bad. And that's just not true. Meaning a down day, if it's coming after a lot of strength, is actually a good thing, right? So if a stock or currency, commodity is steep and uncorrected, think about the word uncorrected, that has a flaw, and we want it to correct, meaning corrections are not bad, they're good. Now, just because this was so violent, the question is, does it have further to go? Hard to say. Let's look at some charts. The first chart is just a simple year-to-date chart of the S&P, and what you can see, of course, is that credible rally off the low, some 47% gain, actually 47.5 from the absolute low on March 23rd, and then this 2-3 day sell-off, which breaks trend. You can see the trend line there, very clear. And so the question is, if and as this continues, and my hunch is it will continue, again, we're down only 7+ percent in the S&P. Yes, individual sectors worse, but the overall market, not that much. And so the second chart is a reference point that anyone can use, and we can look at right here. And simply what this is doing is highlighting the high of the year. Of course, we all know that that was February 19th at 3,400. And then the low, the plunge low, March 23rd at 2,200 plus or minus. And here we are, basically the midpoint. I think we check back at least to the midpoint, and that would be 2,800. So we close the day at 30.41. Again, 1 week is not likely to correct a 15-week, 16-week advance. And so my hunch is lower.
Carter, thank you very much. Don't go very far. We're going to catch you a bit later. I want to bring Bonawyn in. What do you make of Carter's levels here? It sounds like you gentlemen are sharing some phrasing. I think you also agree that not all corrections are bad. It's a correction. That's a good thing, no?
Absolutely. This feels healthy, scary but healthy. I tend to agree with Carter in terms of direction. I'm not sure I can quite agree in terms of amplitude. So that 2,800 level is about 8% from where we are currently. I just don't see the same risks on the horizon. Keep in mind, when we had this violent sell-off previously, the Fed hadn't yet stepped in. We still didn't have accurate measures of COVID. We didn't know what the full effect was going to be of the economy being shut down. And a lot of those unknowns have been removed. We essentially have the Fed now, not only in stepping in with, and providing liquidity, easing monetary policy, we have them expanding into more speculative assets than we've seen in years, if not ever. So yes, I do think we continue to trend down. I think that will be more of a grind than the violence and volatility that we've seen previously. Again, and the last thing I'll say is it seems like there's this instinctual dip buying. And you've got the Fed, you've got a lot of cash on the sidelines. I would, and if you think back to how quickly we bounced from the lows, I really would be looking for opportunities to pick your spots where you're comfortable getting in. Perhaps you do it with calls so that you can define your risk. But I wouldn't be looking for the same balance that we have before.
Got it, Jeff. I was just going to bring up the chart that we're showing right here about these buy on the dips, where after we hit this huge downswing, 5% or more during the recent several months, the next day you get somewhat of an upswing. You may not make up all the ground, but a little bit. So, Jeff, what do you make of that 2,800 idea going further down, or are we going to break out some of these patterns that we've been seeing?
I think 2,800 seems reasonable from a technical level. I mean, the buy the dip is a result of all of this liquidity that we've been talking about. But some of these improvements, some of these things, the virus clarity, some of the off the bottom moves we've seen in economic data, I guess my question is just, is that indicative of an environment where earnings are actually going to improve at all? Are we going to continue to see earnings estimates come down? Because I think what we just saw yesterday, it's an example of a market where if you have some complacency in the options market, the put-call ratio is extremely low, for example, and you have a market where PE multiples are very high, and that E component is still a big question in my mind, you can see these big violent moves when sentiment changes. And I do think there are still some risks out there that really we're not talking about right now. Number one, I think is we're probably going to need some more stimulus. And I think the urgency there seems to have cooled off a little bit because we're getting some better economic data points. The stock market is holding its head a bit. So that's question number one. And nobody's talking about the election. And I think as we go over the next couple of months, that's going to be an additional uncertainty that the market has to deal with. And if you look at Trump's approval numbers starting to come down kind of across the board, Republicans, independents, so what that means for the fate of the corporate tax structure and other things, I think these are big questions that's going to make it difficult for the market to move higher substantially, especially when earnings are such a big question.
Oh, yeah, it's an election year, too. 2020 is just in for a big bag of tricks for us all.